Hello students, Assalamu alaikum and a very warm welcome to all of you on the third day of Practice to Pass webinar for the taxation exam. I'm your tutor Saad Mohammed. Can everybody raise their hands if they can see my screen and hear me clearly? Thank you. Thank you. Okay guys, how many of you have attended the session yesterday as well? Okay, most of the students are here from yesterday. So guys, my name is Saad Mohammed. I'm a member of ACCA and a tutor at one of the Gold Approved Learning Partners. Let me share my third day plan with you and then we'll proceed. Now, the topic that I have selected for today is inheritance tax. We'll be doing two OTQs because normally there's one OTQ that gets tested from inheritance tax out of the three. OTQ, you know that there will be 5 MCQs with one paragraph, and the answer of those 5 MCQs can be found in that paragraph. That is what OTQ is. Along with that, the 10-mark question in the section C can get tested from IHT. So I have selected few questions of that are worth of 10 marks and in which the topic tested is primarily the inheritance tax. So let's start with the first OTQ for the day. You can download the same from the handout sections as well. The name of the OTQ is Adana, and you can find this OTQ in the Kaplan's practice and revision kit as well. So before I start, I would like everybody to raise their hands and give me a go ahead. Okay guys, so let's start. Adana, as I told you yesterday, the trick of the OTQs are to read the requirements first so that I know that what I'll be looking in the scenario. So let's read the requirement first. What is the maximum nil rate band which will have been available while calculating the IHT of 566,000 payable in respect of Adana's chargeable estate? Okay. What is the total amount of deductions which would have been permitted in calculating Adana's chargeable estate for IHT purposes? Now, in the first two MCQs, I know that when I'll be reading the scenario, I should check that how much nil rate band is available to Adana. So I'll be looking for the nil rate band. And the second, they've asked me about the reduction. So I'll be looking at the deductions that Adana can make. Then, in the third, who will be responsible for paying the IHT of 566,000 in respect of Adana's chargeable estate? And what is the due date of the payment of the IHT liability? Now, guys, before I read the scenario, I would like to tell you that if you have good knowledge of IHT, you can answer at least this MCQ correctly. Why is that? Because there is a standard rule that the IHT of the death estate is paid by the representatives of the person that died. For example, if it is Adana in our case, then the IHT will be paid by personal representatives of Adana. Okay. Now, what is the date of the payment? That is what we have to tell as well. The rule is standard that the IHT of the death estate is paid after the end of the month in which the person has died, and then you have to add 6 months in that. So 6 months after the end of the month from which the person has died. So what we'll do is we'll check that on what date Adana has died. Then after ending that month, we'll add 6 months in that. Whatever the date is, that will be the date on which the IHT needs to be paid and will be paid by personal representatives. So A and B cannot be the answer because beneficiary don't pay. The C and D can be the correct answer, but we have to check that on which date Adana has died in the question. Now, how much of the IHT payable is in respect of Adana's estate would have been saved under the terms of her will? Adana made specific gifts of 400 to a trust and 200 to her grandchildren instead of leaving her entire estate to the children. So we'll check that by reading the question. Then, how much Adana did save by making chargeable lifetime transfer of 500,000 to a trust on 22nd April 2009. So these are our requirements. Now we'll be reading the scenario and let's see that what are the correct options. Adana died on 17th March 2021. An IHT of 566,000 is payable in respect of her chargeable estate. Okay. Under the terms of her will, Adana left entire estate which does not include main residence to her children. Now the question has specifically told us that it does not include the main residence, which means that will not be thinking or considering R and RB residence nil rate band. However, I want to tell you that in Finance Act 2020, the amount of residence nil rate band has been increased from 150 to 175,000. Okay. At the time of the death, Adana made the following debt and liabilities. I guess this is what the second MCQ was, that how much deductions can she make? An outstanding interest only mortgage. So I'd like to tell you that interest only mortgage can be deducted. The only type of mortgage that cannot be deducted while calculating the IHT, that death estate, is endowment mortgage. Do remember, all sorts of mortgages can be repayment mortgage, interest only mortgage. These both mortgages can be deducted. The only type of mortgage that you cannot deduct is endowment mortgage. And why is that? Guys, endowment mortgage is a type of mortgage that if the person dies, the insurance company will pay the mortgage outstanding instead of that person. That is why HMRC does not allow, because the person who is inheriting the property will not have to pay any mortgage on that. However, in all other mortgages, the person who is getting the property will pay the remaining mortgage. That is why HMRC allows the person who has died to deduct the mortgage amount out of their asset, because the remaining is not their asset. For example, if I have bought a property from a bank and the worth of the property is 100,000, however, I have bought that on a mortgage. Until now, I have paid bank 40,000 and 60,000 is still outstanding. What does that mean? My as part of the asset is only 40,000. The 60,000 or the 50,000 is still pending at the bank's end. So in my death estate, only my asset part should be included. That's why we always deduct the mortgage out of the property's value when calculating the death estate. However, interest only and repayment mortgages can be deducted. The only type of mortgage that cannot be deducted is endowment mortgage. Then if you have any sorts of taxes and liabilities of other taxes, income tax, inheritance tax, or any other tax, you can deduct those deductions from your death estate as well. So income tax of 43,700 payable in respect of the tax year 2021 can also be deducted. Legal fees of 4,600 incurred by Adana's sister, which Adana had verbally promised to pay. Now guys, do remember that the verbal promises are not legally enforceable. You cannot prove that that person has verbally promised me. There needs to be some evidence. That's why the verbal promises are not legally enforceable and therefore they cannot be deducted. So as far as the deductions are concerned, only first and second can be deducted. The third cannot be deducted. So by reading the question till here, I think I can answer the second part of the question. and that is I have to add 220 plus 43,700. So what will be the correct answer, guys? Tell me in the question section. A is the correct answer, 263,700. Thank you, guys. Now, Adana's husband died on 2006 and 20% of his inheritance nil rate band was used on his death, which means 80% has been left by him. The nil rate band of the tax year 6/7 was 285,000. Even if they would have given me the amount only and not have given me the percentage, I would have calculated the percentage myself, because the only thing relevant here is the percentage. How much nil rate band the person or the spouse that has died has used, and how much percent the band he has left, is that what matters. Why is that? Because only for the spouses HMRC have provided a special arrangement that if one of the spouse dies and they are unable to use their full nil rate band on their death, their unused nil rate band can be used or inherited by their surviving spouse. So the Adana's husband had died before her, which means that she can use her unused nil rate band on her death. Obviously, she has died, her representatives or the beneficiaries will be utilizing the nil rate band of hers and her husband. So, which means that 20% of the nil rate band was available to her. On top of that, her own nil rate band. So, guys, I think I can now answer the question number one, which asks me the maximum nil rate band that is available. All I have to do is I have to take the 80% of 325,000, because that is available as well. On top of that, my 325,000. Now you guys will be thinking why I'm taking 80% of 325,000, which is our current nil rate band. Why I'm not taking 80,000, 80% of 285,000. Guys, the reason is HMRC says that the nil rate band that the surviving spouse should use is should be the nil rate band of the year in which the second spouse died. For example, if Adana's husband has died in the year that is before 2009, so before 2009, the dividend, the nil rate band used to change every year. However, after 2009, it is same, 325,000. So HMRC says that if someone's husband or wife has died before 2008-9, all you have to do is you have to take out the unused percentage, and if the second one has died after 2008-9, you will be just multiplying the remaining unused percentage with your band, that is 325. So we'll not be multiplying 80% with 285, because the rule says that the unused percentage should be multiplied by the amount of nil rate band that was available in the year of second death. And Adana has died in our tax year. In our tax year, the nil rate band is 325,000. So if we take 80% of the 325,000, what that amount will be? It's 80% times 325,000. It's 260,000 plus 325,000 of our own nil rate band. That is 585. So the correct answer in this will be A. A is the correct answer, guys. Now, moving on. On 22nd April, Adana made chargeable lifetime transfers of her shares valued at 500,000. Adana paid the lifetime gift IHT of 5250 arising from this gift as well. If Adana had not made the gift, her chargeable estate at the time of her death would have been 650 higher uh, than it otherwise it was. Okay, so what do we have to calculate? This was because of the subsequent increase in the value of the gifted shares. I guess this belongs to the fourth and the fifth one. The fourth one says how much of the IHT payable in respect of Adana's estate would have been saved if, under the terms of her will, Adana had made specific gifts, 400 to her trust and 200 to her grandchildren, instead of leaving her entire estate to children. Now, guys, you tell me that does it make any difference if you transfer anything to anyone on death? For example, if you transfer something to Mr. A on death rather than Mr. B on death, does it matter? Answer me in yes or no. If on death I transfer something to Mr. A through my will rather than Mr. B, obviously the answer is no, guys. It doesn't matter that on death whether she should have left the few gifts to the children or the trust. Either way, whichever one has received the gift, they would have to pay the IHT, which means what should be the correct answer in 4? What should be the correct answer in 4? Thank you, guys. C is the correct answer. It would not have saved any IHT for them. Okay, because either way they would have transferred it either to the trust, so the trustees would have paid the tax. If the children, then children would have paid the tax, so no tax savings would have happened. Now, lastly, again, the blank box question, which is normally difficult because we do not have any option in this. How much IHT did Adana save if the chargeable lifetime transfer of 500,000 on 22nd April would have remained into her death estate? Obviously, guys, if she would have not transferred that through to a trust and she would have remained that into her state, she would have to pay the tax on her death estate. So, what was the value at the death of the shares? If we look at the question, it has been provided us here that on her death the shares would have been 650. So rather than 500,000, she would have to pay tax on 650,000. So what I can do is I can tell her that if she would have retained the shares, she would have to pay 40% of 650,000. That is 260,000. But I have to tell her what was the additional amount of IHT that she would have paid. So I have to see that how much IHT did she already paid. So it is also given in the question that it is 52250. That was the amount of IHT that she has already paid. So I will deduct 52250 out of that to check how much additional IHT she would have to pay. 207750 is the amount of additional IHT that she would have paid. Please do remember that if they ask you what is the additional amount or the as compared to amount, do remember that if there is anything that they have already paid, you have to deduct that from your savings. So that is why here they have clearly asked how much IHT did Adana would have saved. So how much IHT would Adana have saved? That is my answer, 207750. By making the transfer earlier in 2009, she has saved 207,750, because if otherwise she would have retained those shares in her state, she would have to pay the higher amount of tax, that is 260,000, as compared to 52250. So the difference is her saving because she has made the gift early in her life. So guys, Asma, no annual exemption. Asma has asked, sir, does that also save annual exemption of 3,000? The annual exemptions are available in the lifetime, Asma. They do not have any impact on the death, because if she have made them in the lifetime, the annual exemption would have been available. However, if she would have retained them at the death, there are no annual exemptions available at death. So one of the advantages of making gifts in lifetime from the IHT's perspective is, let me tell you what are the key advantages, because the examiner I have seen, they usually ask that, can you tell us what are the benefits of gifting the assets in the lifetime in IHT? So the usual benefits are, number one, if you transfer anything in IHT during your lifetime, its value will be locked at that date. So if it is an amount, or sorry, if it is an asset that is appreciable in nature, the value that appreciates after your transfer will not subject to IHT. So one advantage. Second is that there are certain lifetime exemptions available. Third is that if you manage to live more than 3 years after making the gift, you will be entitled to the taper relief as well, depending upon how much time do you manage to live. And if you manage to live more than 7 years, the transfer will entirely be exempt at the death. Asma is asking about there is any 500k exemption. Asma, you have to be specific in the question section that which 500k exemption are you talking about. Apart from that, guys, we have finished the IHT OTQ number one. If anybody has any question, they can put it in the handout section, in the question section, before I move on to the next one. Yes, Asma, I know it is a CLT of 500k. What exemption are you talking about? When you make a CLT, yeah, the annual exemption would have been utilized by her in the lifetime. There is no annual exemption that will be available on the death. And they are not asking me about the exemptions. The only thing that they are asking about is the IHT savings. So we have to focus on the IHT payment. Okay, guys. Now I'll move on to the next OTQ. And if meanwhile anybody has any questions, they can ask me in the question section. Because you guys know that the ACCA does not publish their section B usually in their past exam papers, they only publish section C. But in one of the recent attempts, that is March June 19, they have published the March June 19 paper completely. So I have selected another MCQ from that belongs to IHT. Apart from that, I will suggest you that there are three practice tests available on the practice platform of ACCA, where you can not only find the MCQs but the OTQs as well. You'll have the answers available as well. However, if you solve those, because it is a computer based exam, for the section A and section B, the computer will mark your paper automatically. So I'll recommend that do solve two practice tests, one specimen paper there on the practice platform. It will be very helpful for you guys. So the next OTQ is Lebna and Lulu were married couple, but unfortunately Lulu died on 24th of January 2017. You should assume that today's date is 1st March 2021. So do remember that out of the both, Lulu has died and the date of death is always important. It is 24 January 2017. By just reading the preface of the question, I will now read the requirements first so that I can see that what are the things I should be looking for while I'll be reading the scenario. If Lebna were to die today, Lulu has already died. She's asking me that if Lebna were to die today, 1st March 2021, how much of Lulu's nil rate band will the personal representatives of Lebna's estate be able to claim when calculating the IHT payable on his chargeable estate? So again, it is asking me about the calculation of nil rate band of husband and wife. So I have to read the question to check how much his own nil rate band is left and how much of Lulu can she claim. Okay. If Lebna were to die today, 1st March 2021, what is the total amount of residence nil rate band will be available when calculating the IHT payable? So in the first question, it is asking me about the normal nil rate band, and in the second, I have to tell them about the RNRB. Guys, I'll stop here and I'll ask you guys answer me in yes or no that if you remember, the RNRB rule has been announced firstly in 2017. So the person who has died after 2017 is eligible to claim the RNRB provided there is a main residence included in her state in which he or she used to live, and they have transferred the estate to their direct descendants. And the direct descendants mean only and only children and grandchildren. It cannot be brother, sister, mother, father, no one. Children and grandchildren. These are the two conditions of RNRB to be claimed. But you tell me that if there is a person whose spouse has died before 2017 or he she dies after 2017 and they have a residence in their you know state as well and they satisfy other conditions, so their representative will be able to claim the RNRB of the second death that has happened after the 2017. But will they be able to claim the RNRB of the death that has happened before 2017? Answer me yes or no. More answers, please. Azan, thank you. Your answer is correct. The answer is yes. If the second person, or even if out of two, one spouses died after 2017, regardless of the death of first spouse, whenever that has happened, before or after 2017, even if out of two, one spouse has died after 2017, they'll be able to claim the RNRB of themselves as well as their spouse. So the answer is yes, guys. Only one death needs to be happened after 2017 in order to claim the RNRB for both. So do not get confused yourself. This was a important topic or the thing that I wanted to teach you. And do remember this concept when we'll be reading this question because it will help us to answer the MCQ number 27. Now, what is the amount of potentially exempt transfer that we call PET as well, which Lebna has made to his son on 22nd February 2016? The gift of the shares in Bleen Limited after deducting any available exemptions. So we have to calculate the amount of the shares. And normally, if you ask me, whenever I see shares in the IHT, I remember a topic called transfer of value. There are certain assets for which their single value is different as their aggregated value is different. For example, share in a company. If you are a owner of 80% of the company, which means if you have a holding of 80% or more, your share might be of a different value. If I have a holding of 30% or less, I might have a per share value different than yours. So what happens is if HMRC says that if the asset that has transferred is of such nature that its values vary at different levels, the transfer of value or the amount that should be used for the calculation of IHT purposes cannot be calculated straightforwardly. However, what you have to do is you have to see that what is the decline in the wealth of the donor after making the transfer. So for that, what you have to do is you have to calculate the wealth before transfer and the wealth after transfer. If I'll take you to my notes, which are also available in the handout section, the third chapter is inheritance tax, IHT, and in that I have clearly mentioned about transfer of value, that how is it is calculated. It is calculated value before transfer and value after transfer. So there you can see transfer of value. So what you have to take is the wealth before transfer, the wealth after transfer. For example, this is the example that are included in my notes, that Mr. A owned 4 shares and 1 share is owned by his brother. He wants to transfer 2 shares to his son. Value of the shares for IHT purposes are as follows. Share number 1 share worth 5,000. However, when if you have 2 shares, it is not 10,000, it is 14. For 3 shares, it is 25. 4 shares, 38. So you can see that the price is varying at different levels. And Mr. A owned 4 shares, which means that his current wealth is 38,000. If he transferred 2 shares to his son, the value of 2 shares is 14,000, but will not be taking 14,000. Rather, we'll be checking that what is the decline in wealth of the Mr. A. Before it is 38,000 because he has 4 shares, and after he has transferred 2 shares, he'll be left with 2 shares. So after the transfer, his wealth is 14,000. So we'll be taking difference between 38 and 14 rather than taking 14 as a value. So the difference between 38 minus 14 is 24. So we'll take 24 as transfer value rather than 14. Same you have to do with the shares. For shares, what you have to do is you have to take the total wealth before transfer by taking whatever the amount of holding he or she has before transfer and after transfer, and whatever the decline in the wealth is, that will be taken as transfer value. Now I'll go back to the question. Do remember this concept, it will help us to answer the MCQ number 28. Now, if Libda were to die on 1st March 2021, what taper relief reduction would be available when calculating IHT payable on the potentially exempt transfer he made to his son on 22nd February 2016? It is, guys. This is a misprinting. It is 2016, as you have seen in the above as well, that she had made the transfer in 2016. So do count from 2016 onwards about the taper relief. Now for this MCQ, even if I don't read the question, I can answer this. Why? Because the death date has been given to me, and by using the death date, I can not only calculate that on which date the IHT needs to be paid for the death estate, but also the percentage of the taper relief. Now do remember that for taper relief, the table will be given to you in the question. All you have to do is to see that what is the difference between how much time has has gone between the 1st March 2021 and the 22nd February 2014. So you tell me from 22nd February 2016 till 1st March 2021, how much years have gone? If I take exactly 5 years, they will be in February 2021. But the death has happened even after 5 years. So I guess 5 to 6 years. And for taper relief, the table will be given to you in the question. You do not have to learn that. So if I discuss with you here, there you can see. In 5 to 6 years, the percentage of taper relief discount is 60%. So if I come back to the question, the answer can only be either A or B. It cannot be C or D. Then I've told you in the last question that what is the method to calculate the due date of the death estate tax. I have just told you in the last question. So I'll stop and wait that you guys answer me that what is the correct option, A or B. Thank you guys who have answered A. Their answer is correct because what I have told, what some of you have missed the point, that after the end of the month on which the death happens, then you have to add 6 months. So 6 months after the end of the month on which the death has happened. So the death has happened in 1st March 2021. You'll first end 31st March, then add 6 months, so it will become 30th September. Okay, so 30th September is the correct answer, not the 1st September. Now, what amount of cash gifts made by Lebna to his friends during the October 2020 is covered by small gifts exemption? I'll stop here and I'll ask you that can you tell me that what is the amount of small gift exemption available? Thank you guys. Subhan, your answer is absolutely correct. It's not only 250, but it's 250 per person in a tax year. So you can make 10 gifts less than 250 to 10 different individual, but you cannot make 5 gift of 250 less than 250 to one person in a tax year. So do remember it is 250 per person per tax year. So you can, again, I'm telling you that you can make 10 gifts of less than 250 to 10 various persons, but you cannot make more than one gift of 250 to one person in a particular tax year. So the correct answer is 250 per person. Do remember it will help us to answer the last question. Now, thank you, Sally, but you were very quick. Let me read the question. Okay. Lulu left an estate valued at 210 for an inheritance tax purposes. The estate did not include the main residence. So, okay. Under the terms of her will, Lulu left a specific legacy of 40,000 to her brother, with the rest of the estate to her husband, Lebna. Okay. Lulu had made the following lifetime transfers. 13th February 2009, chargeable lifetime transfer of 50,000, and 21st June 2015, potentially exempt transfer of 80,000. Now, if you look at the date of her death, that is 24 January 2017, I can tell you that one of the gift is exempt. You tell me which one, the first one or the second one. The first one, guys, and the rule is that all of the transfers which are before the 7 years of your death are exempt. So 7 year rule needs to be applied here. Before the 7 years of death, all of the transfers that you have made are exempt at your death. So the first one, that is on 13th February 2009, that will be exempt from the death estate. So the first one. Okay. Now, the nil rate band on that year 2016-17 was 325,000. Okay. Lebna's chargeable estate. Lebna has chargeable estate valued at 980. His estate includes a main residence of 340, on which there is an outstanding interest only mortgage of 152,000. Now, guys, you answer me. Can I deduct interest only mortgage of 152,000 from this property? Interest only mortgage is allowed? Yes, it is allowed. The only type of mortgage that is not allowed is endowment mortgage. In interest only mortgage or repayment mortgage, these two types of mortgages are allowed to be deducted. And do remember that R and RB is 175,000. However, if your property after deducting the mortgage is less than 175,000, your R and RB will be restricted to that amount. You will not be able to be entitled to complete R and RB or R and RB in full. Okay, so do remember that. Now, I have therefore read about that what RNRB or NRB can be available to Lebna or Lulu. So let's calculate that what is the NRB that Lulu has used in her death estate and what is left. Whatever is left, we'll then add it into Lebna's estate and we'll be able to calculate how much NRB Lebna has. So you tell me, out of these, she has gifted 40,000 of a legacy to brother, then 50,000 chargeable lifetime transfer, and 80,000 potential exempt and transfer. You tell me which amounts will I shall use in calculating the NRB left for Lulu. Which amount, guys? 40,000 and 80,000. These two amounts will be used, and 50,000 will not be used as this is before 7 years. So this has been exempt on her death, so it will not use the nil rate band. The only two amounts that would have utilized the nil rate band amount were the ones that are chargeable on her death. So the gift that she made to her brother on her death must have used the nil rate band, and the potentially exempt transfer that she made in the 21st June 2015. The, now guys, I want to ask you a question. What about the rest of the estate of 210? Didn't that utilized her nil rate band? Answer me in yes or no. Her total estate was 210. So wouldn't that utilized her nil rate band? Subhan, you have said no. Can you answer me? Gitin Joseph, why no? Very good, guys, because the estate has been left to his spouse. Whatever you left to your spouse is totally exempt. It does not use any of your exemptions and it is exempt on the top of it as well. So do remember that Lulu has made the following gifts that they told us in the question. Apart from that, everything else she had left to her husband. Okay. So that's why only out of 325,000, I will deduct the two amounts. That is 325,000 minus 40,000 that has been left to brother and 80,000 that was a gift on 21st June. 205,000 of the nil rate band was left. So guys, what is the correct answer? How much Lebna can take out of Lulu's nil rate band? Which answer is correct? Obviously the answer B. B is the correct answer. Now let's talk about R and RB. So now I have told you the rule of R and RB in the last question and in this question as well. You tell me that When Lebna, when Lulu died, in her estate, there was no residence included. However, when Lebna is going to die, in his state, there will be a main residence of 340,000. I know that Lebna will have his own RNRB, but will he be able to claim Lulu's RNRB? Yes or no? More answers. All of you who are saying no are wrong, because I have told you it does not matter when the first spouse has died, whether the estate was included in their residence or not, because even if the rule does not exist at that time, still the RNRB is available to the second spouse, provided the second spouse satisfied all of the conditions. That is the death after 2017, the main residence, and the transfer to the direct descendants. These are the three conditions. If the second spouse fulfills that, he'll be able to claim the RNRB of first spouse, even if he or she did not had fulfilled any of the conditions. So the answer is yes. So guys, amount of the RNRB is 175,000 times by 2 equals to 350,000. You tell me. So the correct answer is B, or do I have to do any other calculation as well? Just answer me in yes or no. Is the answer is B, 350,000? More answers, please. All of you who saying yes are wrong, because I told you that if your property is less than the amount of RNRB available to you because of the mortgage, your RNRB will be restricted. So if we read the question again, it is clearly written here that the residence was valued at 340 less 152 of the interest only mortgage, which means that our, although we have 350 as our RNRB available, but our property is less than the 350. Therefore, the RNRB will be the amount equivalent to the amount of the property that is chargeable. So the amount of property that is chargeable is 340,000. On that, there is 152,000 of the mortgage. 152,000 of mortgage. So the answer is 188,000. Although I had 350,000 of RNRB, but my property is not that much. So the RNRB will be restricted equal to the amount of 188,000. So the answer of 175,000, that he only has his own RNRB, is wrong. 350 is wrong, that he'll have the RNRB of both. The correct answer is 388. That is the amount after deducting the mortgage. So in our option, D is the correct answer. Moving on. What is the amount of potentially exempt transfer which Lebna has made to his son? Okay, so let's read the remaining question. On 22nd February 2016, Lebna made a gift of 60,000 shares in Bleen Limited, an unquoted investment company, to his son. Before transfer, Lebna owned all of the Bleens Limited share capital. It means that she must have 100% shareholding. The market value of Bleens Limited ordinary share on 22nd February 2016 were as follows. For 100% holding, your share is worth 7.1. For 60 and 40, these are the values. You tell me, guys, if Lebna has made 60,000 shares as a gift to his son, what will be his wealth left after the transfer? Will she be the owner of 40% or 60% after making the transfer of 60,000 shares? Tell me the percentage. 40%. Thank you guys. So what I'll do is I'll calculate her wealth when she was on 100%. I'll then calculate her wealth again when she was on 40%, and whatever the difference is will be the transfer of value. So at 100%, she has complete 100,000 shares with 7.1. So obviously 7.1 times 100,000 means 710,000. Now at 40%, she must have 40,000 shares because the complete capital is 100,000 and 40% of that will be 40,000. 40,000 times 4.2. Let's see what is 40,000 times 4.2 equals to is. It is 168,000. Now minus 710,000 to check what is the decline in wealth. 542,000 is the decline in wealth. Now guys, shall I answer 542 or is there any exemption that I need to deduct from it? Is A the answer? Faizan, taper relief is available on death. So do remember it is a lifetime gift and we are not calculating his inheritance tax liability. We are only calculating the chargeable amount. So there will be no taper relief. Yes. Sally, you are right. And Asma, you are right. Annual exemption. Whenever you make a lifetime gift, annual exemption is the most one that you remember. It is an annual exemption, and not only for this year. I'll assume that there is no transfer before that. I'll take the annual exemption of both years, that is 6,000. So out of 542 I will deduct 6,000. Now the correct answer should be 536, that is A. So this is one common mistake that the students may make, that they forgot to deduct the annual exemption. Just to make sure that whether you're required to deduct the annual exemption or not, always deduct it and look, is there an answer after the annual exemption value? Is there any option with the after exemption value? If there is, then that will be the correct answer. The 29th one we have answered already. That is A, 60 and 30th September 2021. And now we are only left with the gift part, which must be information related to must be here. Lebna made cash gifts of 85, 225, 190, and 490 to various friends during the October 2020. Now, if all of these gifts were to different persons, apart from 490, all three gifts would have qualified for the small gift exemption. But the gifts of 85 and 190 were to the same friend. So, guys, now you tell me which gift out of these four qualify for small gift exemption. Tell me the amount in the question section. Sajid, 250 is the amount of exemption. You tell me which gift is exempt or eligible for small gift exemption out of that. Only this one, 225 one. Why is that? This 85 and this 190 is to the same person, which means if you add them up, they will cross the value of 250. So that person has crossed the value of 250. So both of these gifts will now not subject to small gift exemption. They can qualify for the annual exemption, but here they have specifically asked me about the small gift exemption. So 225 one, 490 can obviously does not qualify. And as far as the 85 and 190 are concerned, because they are to the same person, that is why they have crossed the value of 250. So my correct answer is C, which only states 250. Now guys, before moving on to the break, I would first like all of you to raise your hands that you have understood completely the two OTQs that I have taught? More hands, please. Participation is required. Okay, now you can ask questions before I go on to the break. Yes, Asma, that is what the problem with the small gift exemption is. If the gift is till 250, the complete gift is exempt. If it is 251, complete exemption is not available. Any questions, guys? If you have, you can ask. Otherwise, we are going on to the 5 minutes break. Okay, so see you after 5 minutes. Okay, guys, let's start. Before I start the next question, please raise your hand that you're ready. Okay, Rubina, as far as your question is concerned, when we'll be doing section C questions which need longer calculations which needs to be told, that I'll be solving on the spreadsheet. However, basic plus and minus, there is no need to be solved them on the spreadsheet. So, as per the plan, now we have to do section C questions. There's a question called James, Marcus, and Dembe. These are the three questions that I've selected. Dembe is obviously a multiple tax question. If you remember, I've discussed with you in the start that the examiner now likes to teach question number 10 of section C on different types of taxes with small requirements on each. So the Dembe is sort of that question. However, James and Marcus, they will primarily be focusing on the IHT. Both of these questions can be found from the Kaplan kit as well. However, I'll discuss and solve with you over the spreadsheet. So let's start with James first. We'll read the requirement and then we'll start solving the question. So the first requirement is calculate the inheritance tax which will be payable as a result of James' death and state who will be responsible for paying the tax. So we have to calculate the inheritance tax payable that James has to pay. They can be on lifetime gifts as well, and they can be on death gifts as well. Now, guys, if I stop here and ask you what is the order, for example, if one has made some lifetime gifts as well, as long as death gifts as well, which means the gifts on death estate. When we have to apply the CGIHT and the nil rate band, which comes first? The lifetime gifts comes first or the death gifts comes first? Thank you. The lifetime gifts always comes first. They are entitled to nil rate band as well first, and then if there is some nil rate band that is left, only that can be entitled to the death estate. And on death, there is no exemption available. There is only nil rate band available. The gifts can only be exempt if they can be either given to charity or spouse. Okay, otherwise no exemption is available. Now explain why it might have been beneficial for IHT purposes if James had left a portion of its estate to his grandchildren rather than his children. Guys, that I told you yesterday as well, that what is the advantages if you transfer the assets to your grandchildren rather than children? You tell me. Wonderful answer, Sajid Ali. Generation gap. Yes. No, Rubina, they have to pay the tax, but the tax of one generation gets saved. Why? If you transfer it to your children, then they have to pay the tax on your death. Then, if they transfer to their children, your grandchildren then have to pay the tax as well. So it will be taxed twice. However, if you directly transfer to your children, provided that your children are wealthy enough and they don't need it, or they plan to give it to their children anyways, so you can directly transfer it to your grandchildren, thus saving a IHT of one generation. Okay. Quick succession is not the topic of taxation, it is the topic of advanced taxation. Now, The requirement number B, that is worth of two parts, can be easily answered by stating that if they would have given it to their grandchildren, it would have skipped one generation tax, thus stopping the asset to be taxed twice. And by explaining simply that, you can take 2 marks. Again, I want to tell you that there are no marks deduction for grammatical errors or spelling mistakes. So do remember that it is a computational exam and examiner does not deduct marks for these things. And your explanation needs to be precise. If there can be 2 bullet points, then explain in 2 bullet points. If in one, then one, but it should be explained in bullet points using the word processor function. Now, moving on, explain why it might be advantageous for IHT purposes for a person to make lifetime gifts, even such gifts are within 7 years of death. Your answer should include a calculation of James' inheritance tax saving, making the gift of a property to a trust on 2nd August 2019, or rather than retaining the property until his death. Okay, so for that I have to read the question, but you guys know the general savings that one can make or the general advantages that one can obtain by making more lifetime gifts. The first is because he is in the second point told me that I should not talk about lifetime exemptions. So the advantages apart from the lifetime exemptions are number one, the value gets locked, and if they are within 7 years, within 3 to 7 years, there is availability of the taper relief. So I can obtain 1 mark for that, and the 1 mark would have been for the calculation that I can do after reading the question, that there is some gift of property that if he made it earlier could have saved some tax. So that I have to read the question. So two requirements have already been solved. Let's talk about the first one. James died on 22nd January 2021. He made the following gifts during his lifetime. Now I'll split my screen half and half with spreadsheet so that I can solve this question with you. Now, James died on 22nd January 2021. Important date to be remembered so that we can see what are the gifts that are exempt and what are the ones that are chargeable on his death. On 9th October 2013, a cash gift of 35,000 to a trust. No lifetime inheritance tax was payable in respect of this gift. So guys, if I start from this one, I'll write James first, bold it, and mention here specifically that I'm solving part A for the understanding the examiner. Now, the first gift that is on 9 October 13. Is it chargeable, guys? Is it chargeable on his death? I know it is a CLT, but is it chargeable on his death? And the answer is no. Why? Because the 7 year has been elapsed. From 9 October 2013 to 9 October 2020, there'll be 7 years complete, and he has died after the October 2020. So the 7 year has elapsed. So this will not be chargeable on his death. So I can score an easy mark just by mentioning that it is exempt 7 years past. Okay, simply that. Then the second one, 14th May 2019. This one, a cash gift of 420,000 to his daughter. As it is in 2019, you can clearly see that this cannot be exempt as this is within 7 years of the death. And if I check about the taper relief, I guess the taper relief will also not be available to that. Why? Because 2019 till 2021, it is less than 3 years, because the 3 years period would have been completed on May 2021, and he has died before May 2021. So to calculate his tax liability, I'll first write the value, that is transfer value. It is 420,000. Now, shall I deduct any lifetime exemptions out of that? Yes or no? Yes, the answer is yes, guys. If the if he would have given me a chargeable amount directly in the question, that then I would not have. But he has not given me the chargeable amount. He has given me the transfer value, the value in which they have transferred. So if do remember, if the wording is chargeable amount of that gift was this, it means the annual exemptions or the reliefs have already been deducted. But if it tells you the amount straight away, then you have to deduct the annual exemptions yourself. So you have to deduct the annual exemptions. I'll deduct AEs and mention that it is annual exemption for both year, because there was no gift in 2018 as per the question. So I'll taking both annual exemptions, minus 6,000. So now the chargeable amount is equals to this plus this, 414,000. Now guys, my question is the nil rate band allowed or available? NRB? Yes, it is available. But how much? The complete NRB is 325,000. But every time you give NRB to any transfer on death, always do check that is there any transfer in between the 7 years from the date of that transfer and before. So this transfer has been made on 2019, 14th May 2019. Check that is there any transfer within 7 years of that transfer, not of death. You do not have to look back from the death as far as the 7 years are concerned, because if we are calculating nil rate band for death estate, only then we look back 7 years from death. If we are calculating nil rate band for any lifetime transfer, we always look back from the date of transfer, not the date of death. So we are looking, or we are calculating nil rate band for a lifetime transfer. So we will check back from the date of transfer. So is there any transfer that has been made before 7 years? I can see that there is one, this 35,000. So this would have used the nil rate band. So what would have been the remaining nil rate band? 325,000 minus 35,000. But guys, is that correct? Is that correct, or is there any mistake? Guys, you have forgot to highlight that while calculating the consumption of nil rate band, I should have deducted 6,000 from the as an annual exemption from this value as well, because nil rate band utilize the value that is after the exemptions. So the nil rate band would not have utilized complete 35,000, it would have utilized 29,000 rather. So what I'll do is here in my calculation show 6,000, and in my formula I'll update it with plus 6,000 plus here as well. Reason being why I have plus, because the nil annual exemption would have saved my nil rate band. Or the easier thing you could have done is that 35 minus 6,000, you could have deducted 29,000 as well. This would have resulted in the same answer as well. So for your ease, let's do that. It will make it more easier for you. 29,000. Sorry, formula 29,000. So the nil rate band is 296,000 that is left for this transaction. Now, taxable amount. Taxable amount is this minus this. On 118, the IHT will be applicable, and IHT is 40%. So equals to this amount multiply 40%. 47,200 is the IHT that will be payable in the result of James' death on this transfer. The first transfer is exempt. That one is exempt. That one I have calculated the IHT, and now only one transfer is left. That is a CLT that has been made. On 2nd October 2019, a gift of a property valued of 260,000 is to a trust. So trust means that it is a CLT. No lifetime inheritance tax was payable in respect of the gift because it was covered by nil rate band. By the times of James' death on 22nd January, the property has increased the value of 310. So that was the requirement in the last part, that do calculate the saving, that what is the benefit that James had because of making the gift earlier rather than retaining it in the death state. So it is pretty obvious, guys, that he has saved the difference of the value as inheritance tax. If he would have kept it till death, there would have been a tax of 310 at 40%. However, now the tax will be applicable on 260,000 rather than 310,000. So the difference between them, that is 360,000, sorry, 310,000 minus 260,000, 50,000 times 40%, because there would have been a 40% IHT. 20,000 is the amount of IHT that James has saved by making this transfer earlier and not retaining in the death estate, because otherwise its value would have increased to 310 and he would have to pay the tax at 310. So that is the additional amount of tax that he would have paid, but now he has saved by making the transfer earlier. Moving on. Now I have to calculate for this part. The transfer is made on 2nd August 2019. I will bold that. Its value is, TV stands for transfer value. Its value is 260,000. Now this has been made in 2019 as well, and the transfer before has also been made in 2019 as well. Now I would like to ask you guys, is there any annual exemption left for this one? No annual exemption. Okay, why? Because the gift has been made in the same tax year. So the only one annual exemption is available per tax year that has already been utilized by the cash gift of 422 daughter. So there will be no annual exemption available. AEs will not be available. So this will be its chargeable amount as well. that is 260,000. Now guys, is there any nil rate band left? Because if you look at that date before 7 years, don't you think that the nil rate band has been completely utilized? Is there any nil rate band left? Thank you. No nil rate band left. So less NRB, that is 0 as well. No NRB left. So again, the taxable amount is 260 as well, and IHT at 40% will be this amount times 40%, 104,000. 104,000. Now, moving on 21st January, James' estate was valued at 870. Under the terms of the will, James left his entire estate to children. The nil rate band of James' wife was fully utilized when she died 10 years ago. It means that he only has his own nil rate band. He does not have his wife nil rate band available. So let's calculate the death estate tax. Estate value is 870,000. There is no annual exemption available at death estate. The only exemption that would have been, or the relief would have been available, was nil rate band. But guys, is there any nil rate band left by the lifetime transfers that can be used by death estate? No. So no NRB left. So IHT will be straight away at 40% for the death estate as well. So this times 40%, 348,000 will be the IHT on death estate. I have not only calculated the tax for the particular lifetime transfers, then I have also calculated the death estate tax. Now there is so much confusion about nil rate band because it is quite a tricky part. So I will now spend few minutes on explaining you that how nil rate band works. Guys, nil rate band gets reset after 7 years. So if there is a transfer that you have made that may have utilized the nil rate band even, but after 7 years are elapsed, the nil rate bands gets reset. So you will not consider that usage in your nil rate band utilization. Okay. However, if there are any transfers that have been made in the last 7 years, that can be used as a calculation. For example, let me give you an explanation. For example, if there is a person who has made transfer in 2010, okay, in 2010 he has made some transfer, and that transfer was 200,000, let's say. Then after 7 years in 2018, he made another transfer worth of 250,000. He's still alive, obviously, that's why he has made the transfer. Now in 2020, without making any transfer, that person dies. Now you tell me that when we'll be standing at his death, will that transfer be chargeable because 7 years has been elapsed? The answer is no. Then will that be chargeable? The answer is yes, because this transfer has just been made 2 years before his death. Now, will the nil rate band be available to this transfer? The answer is yes, but we have to check that is there any transfer that has utilized the nil rate band between 7 years before that? The answer is no, because this transfer is 8 years old. This was made in 2010 and this was made in 2018. So as the 7 year has gone or elapsed, the nil rate band has been reset and it is available for this transfer. Now imagine that between these two transfer, for example, if there would have been a transfer in 2014, okay, and that transfer was 50,000, or let's say 30,000, okay. Now imagine that you standing here checking that is there any amount or transaction or the asset that utilize nil rate band. The answer is yes, that is this one. This has utilized the nil rate band. 30,000 or not? Not 30,000. You first have to deduct the annual exemptions from that amount. So you'll first deduct 6,000. The answer will be 24,000. So the nil rate band that has been utilized by this transfer is not 30,000, it is rather 24,000. Because you have to remember two things. First, you have to check that is there any transfer that has used the nil rate band. If the answer is yes, then the amount you should take for the utilization should be the amount after the annual exemption, not the one that was gross of the annual exemption. That is why some students were asking me, sir, why you have minus 6 from this 35? Because the 35 was the gross amount. When I had to look at how much nil red band has been utilized at the gift of 420 that was made to daughter, I have to deduct the 6,000 from the 35 first and then take 29,000 as a utilization. So I've tried to explain you because it is a bit confusing. Now, can you guys raise your hands that you have understood what I tried to tell you? I'm glad, Sajid and Rubina, that you have now learned how the nil red band works. Subhan Faruqi, raise your hand, please. Riha, thank you, Riha. Okay, guys, a 5-minute break and then we'll do another question. Okay, guys, let's start. Quickly raise your hands if you're ready. Okay. Okay, guys, let's move on. The question is now Marcus. I'll zoom the question for you. Later on, I'll split my screen. Inheritance tax legislation does not actually contain a definition of who is and who is not a chargeable person. Required explain whether or not married couple is treated as a chargeable person for inheritance tax purposes. You tell me, guys, do they? Obviously, the answer is no, guys. Married couple are not treated as a chargeable person for the inheritance tax purposes. That is the answer. Simple as that. For 1 mark, you're not gonna write more than that. Now, state the special inheritance tax purposes or mayas which are applicable to married couples that we are well aware of. What are the special mayas, guys? Yes, Gatin. The first is that they are treated as an exempt for inheritance tax purposes. That is the first mayar. You're right. There is another one which we have constantly dealt with in our OTQs. We have dealt that in our yes, Rubina, you're right, nil rate. The spouses can transfer their unused nil rate band to each other and their R and RB to each other. Okay, these are the two special advantages that number one, they are treated as an exempt for each other, exempt party. The second is that they can utilize the unused nil rate band of each other and their R and RPs as well, if available. Okay, now we have done with the first part and we can easily score 3 marks if we know that basic knowledge. Let's read the requirement. Calculate the inheritance tax which will be payable as a result of Marcus' death. Again, we have to calculate the death tax on some transfers. So that will further strengthen our understanding of the how lifetime gifts are taxed at death. So I'll start with Marcus died on 31st December 2020. So this is an important date. It will help us to determine which uh, are the exempt transfers and which are the chargeable. He had made the following lifetime gifts. On 14 January 2009, Marcus made a chargeable lifetime transfer of 315 to a trust. The trustees paid lifetime inheritance tax of 6,000 which 600 which arose in respect of the gift. Now guys, you tell me, is it a chargeable transfer at the time of death? He has died in December 2020. Obviously no, because the 17 has been elapsed. So the answer is correct. But do remember that this transfer will trouble us when we'll be calculating the nil rate band for the other transfer. Because if there is any other transfer that has been made within 7 years of that transfer, when we'll be calculating the utilization of nil rate band, then this transfer will be used. Okay. On first Jan on the second transfer is on 3rd December 2015. Marcus made a chargeable lifetime transfer of 395,000. Now, the 31st December 2015 is well between the 7 years if we look at from 31st December 2020. So this transfer is chargeable and it's a CLT. He made a CLT of 395,000 to another trust. In addition to the gift, Marcus paid the lifetime inheritance tax of 96250. Now, guys, I want to ask you that I know that in one instance, the lifetime tax paid will also be added back to the chargeable lifetime transfer amount of the asset. Now you tell me, when this does happen, when the donor pay the tax themselves or when the trustees pay the tax in lifetime? In one instance, the tax is also added into the cost of the transfer. When does that happen? When trustees pays the lifetime tax or when the individual pays the lifetime tax? You're absolutely right, guys, Rubina Suban. It is the donor. When the donor pays the tax, it will be added into the cost of the asset. When trustees pays the tax given, it does not get added. However, in both circumstances, you're allowed to deduct that as a lifetime tax already paid while calculation of the death lifetime gifts at death. Okay. Now, you tell me here, Marcus has paid the lifetime gift and the amount has also be given in the question. You tell me, will we add it or not in the price? Guys, will we add the amount of tax in the transfer value or not? We will add, because it is clearly written here that the Marcus has paid the tax. Okay, so we will add Marcus paid the related lifetime inheritance tax of 96250. Okay, then on 3rd January, on 1st January 2016, Marcus made a gift of potentially exempt transfer of 30,000 ordinary shares in Scarum Limited, an unquoted investment company, to his daughter. Again, guys, shares are of such type that their value is different in different levels. So we'll not be calculating the value in straight away. We'll be using the method that tells us what is the decline in the wealth. So before the transfer, Marcus owned all of the share capital of 100,000. On 1st January, the shares were 5 for the holding of 30%, 9 for the holding of 70, and 12 for the holding of 100. Now, guys, I know that before the transfer, Marcus has 100% holding of the company. You tell me, after transferring 30,000 shares, how much holding was left? How much holding was left, guys, in terms of percentage? 70. 70%. Okay, so the wealth before transfer was 100%, the wealth after transfer was 70%. And in terms of shares, it was 70k, 70,000 shares. Okay, so when we'll be calculating, we'll first take value before transfer by multiplying the price that is for 100% holding, then for the price that is for 70%. So let's start solving the question and let's see that what is the tax liability or inheritance tax liability. Okay, guys, we start with the first transfer. First, I will mention here that it is Marcus. Then, for examiner, I'll mention here that it is part B. Then, for each transfer, I'll mention a date and then start solving it. So, the first one is 14 Jan 09. Again, I'll tell examiner that exempt y 7 years past. Now, for the second one, that is on 31st December 15. Or I can write the date in the similar format. Their transfer value is, we'll write TV. TV is 395,000. But as you remember that because Marcus has paid the lifetime gift, or Marcus has paid the lifetime tax of inheritance, we have to add that back as well. And that is mentioned in the question as 96250. So the final TV will be 491250. Now I know the nil rate band is available for this transfer, but before this transfer, is there any transfer that would have used the nil rate band? Is there any transfer, guys? Yes, Sally, you're right. The 2009 one. Okay. The transfer that was made in 2009 used the nil rate band. Now, the question is, how much would had it used? What was its value? Its value was 315. Now, this is a chargeable lifetime transfer value given to us. So I'll not be deducting any annual exemption from that because it is the chargeable value. So to calculate NRB, I will state here less NRB, and I'll tell examiner that I have computed NRB as 325,000 minus 315,000. So the remaining NRB would be 10,000 only, 10,000 only. So what will be the chargeable transfer value? This less this, 481,250. The IHT on that will be 40%. That is this amount times 40%. Now I will stop here and ask you, is there any taper relief available if we compare the transfer has been made in 3rd December 2015 and the death has happened on 31st December 2020? Is there any taper relief? Yes, Ziad, we will not deduct annual exemption from 315 because here direct the chargeable amount has been given to us. I have told you in the last question, if the chargeable amount is given, we will not deduct annual exemption here. Yes, there will be some taper relief available as the 3 years has passed because on 3rd December 2018, the 3-year period has elapsed. However, the death has happened on 31st December. So if I add straight 5 years in that, on 3rd December 2020, 5 years have been completed. So did the death happen after 3rd December or before 3rd December? Obviously after the 3rd December. So it will fall in 5 to 6% category, 5 to 6 years category. And in 5 to 6 years, if we consult our notes to check what is the amount of taper relief available, it states 60%. 60% is available. Now that discount percentage applies on this tax. So TR stands for taper relief at the rate 60%. Guys, I want to tell you one more important thing that you always have to remember. There are two deductions that are allowed for IHT at death. One is taper relief and another is lifetime tax already paid. But do remember, the order should be the one that I am telling you. Taper relief always gets deducted first, then you deduct the lifetime tax already paid. So I will first deduct the taper leaf, that is 60% of that amount. And if I put minus in the start of the formula, it will automatically convert the figure into negative. Now, LT stands for lifetime tax already paid. It is given into the question, that is, I have used here as well 96250. So I can use this amount. Now, if remember remember this point and listen this point carefully. If after deducting the taper leaf and the lifetime tax already paid, the answer gets in negative or you get a refund from HMRC, there is no refund for IHT already paid, or the refund that has been made up because of the discounts or the reliefs that HMRC has paid you. So if the answer is negative, you will not be able to recover any IHT from HMRC. You'll write 0 as your answer rather than a negative answer. So here I can see that it may result in a negative figure because my IHT at 40% is this. If I deduct this amount and this amount from that, my answer is negative 19,250. It means there should be a refund of 19,250, but HMRC does not give you any refund. So IHT payable will be 0. You should write 0 in your answer. Okay. Now, if there is any misconception why I have not taken annual exemption here while calculating the nil rate band, and in the last question, I've told you that here we were given the chargeable amounts directly of the asset. Okay. Now, before I move on to the next transfer, I would like everybody to raise their hand and to let me know that they have understood this. Raise your hands again. Okay, Ziad, did you find out why I have taken the values in the last question and not in this question? Good. Okay, guys, let's move on to the other adjustment. I have dealt with two gifts. On 1st January, Marcus made a gift of 30,000 shares. So let's talk about the share gift in which we have to use the transfer value method. So I'll give the heading first, that is 1 Jan 2016. Now, on 1 Jan, the shares have been made and of 30,000, and I have not been given with the chargeable amount. So I have to calculate the chargeable amount myself as well. Now let's calculate what is the transfer value. Before transfer and after transfer, I will calculate Marcus wealth. So before transfer, the value that I will use will be the share price for 100% holding was 12 times. He has complete holding of the company of 100,000 shares, and after he had 70% of the holding, and for 70% the value of the share is 9, and the amount of share he was left with was 70,000. Okay, now whatever the values will be, we'll write here. This will always be obviously 1.2 million. This will be 630,000 because 9 sevens are 63, or you can put formula as well if you are unsure. Now here this minus this is the transfer value that I'll be using for the gift. Now, as the gift has happened immediately after the one that has utilized all of the nil rate band, do you think that will there be any nil rate band left for this share gift? Tell me yes or no. Because now if you look back in 7 years, there are two transfers that has used the nil rate band. The January 2009 one that has used for 315, and the 10,000 left was also used by the transfer that we made on 31st December 2015. Is there any, guys? No. The answer is no. Okay. Now we'll see that is there any taper relief available for that. Now you tell me the gift has been made on January 16. The third year time elapsed on exactly January 19. So obviously, if the death has happened after January 19, the taper relief is available, and the death has happened after January 19. So at 31st December 2020, how much relief will be available? 40%. Why? Because it is within between 3 to 4 years. If the death would have happened after January 2021, then it would have qualified for 5 to 6 years, but as the death is between 4 to 5 years, the taper relief will be 40%. So we first have to apply the tax. Out of that we'll deduct the taper relief. So IHT at 40% is this amount times 40%. Then the taper relief will be at 40% as well, but taper relief will be 40% of this amount, because this is the total tax. Out of that, 40% will be discounted. I can put a negative sign in the start to make the figure completely negative. So the IHT payable will be this minus the discount. 136,800 is IHT payable. So with that, the second part gets complete as well. I will welcome now questions from you guys. IHT is a bit tricky topic, but for that I will suggest you to solve as many as OTQs you can for IHT, because an OTQ is a confirmed. However, a section C question, it may come, it may not. So when it comes to IHT, your complete focus should rather be on OTQs. It will also help you to learn the concepts, and if a question comes in section C, you'll be able to answer that as well. If there are any questions related to IHT, you can put in the question section. I'll also take you to my notes and tell you that in that there's a complete chapter of inheritance tax with easy explanation of certain reliefs and proformas as well. Okay guys, a 10-minute break and then we'll come back and we'll solve a complete question called Dembe. And Dembe is a question that deals on multiple taxes. That is, in that you'll find inheritance tax, capital gains tax, and income tax. So these are the questions that you would like to, or you should preferably be practicing, as the examining team likes to test these type of exams. So see you after the break. Okay, guys, let's start. Raise your hands and tell me that you're ready. Okay, so next question is, as per the plan, Dembe. So Dembe is also the question of a latest attempt. You can find that in Kaplan Kit as well. And it is a 10 mark question and it deals on multiple taxes. So let's read the requirement first. But if you look at the heading, it has inheritance tax in that, it has sale of residential property in that, and it has personal pension contributions in that. Now, guys, I will stop here and let you know a change of the Finance Act that has been made. Previously, what used to happen was whenever you sell any asset in capital gains tax, you had the time to pay its tax. For example, any asset that has been sold and you realized a gain on that, to pay the capital gains tax on that, you have the time till 31st January following the tax year. This has been changed only and only for the residential property. If you sell residential property, you now have to pay the tax within 30 days of selling the property. Okay, so for selling the residential property, that 31st January till time period is not at all more available, but that is only and only for residential property. And whatever the tax that you have already paid in respect of the residential property, when you will be calculating your total tax liability for the CGT, that tax can be deducted as tax already paid. Okay, so this is the Finance Act change that I wanted to tell you. Inheritance tax, there was no Finance Act change. Instead, that the RNRB has been increased to 175,000. Okay, now let's go to the requirements. Calculate the reduction in T's income tax liability and NIC for the tax year 2021 if she makes the personal pension contribution of 32,000 net. Now the question has specified that it is a net contribution. Now you know that if we gross it up, with the help of gross amount, we'll be able to take certain advantages. The main one is that our bands, the basic rate band and the high rate bands, will get extended by the amount. Now I will request you guys to gross it up and tell me the gross amount in the question section, please. Yes, 40,000 is the amount. There is no donor and donee Subhan. It is not an inheritance tax. It is a personal pension contribution. Okay. So all you have to do is you have to gross it up, and the formula is multiply it by 100 divided it by 80. 100 over 80 is the formula. Now, the one advantage is that your band will be extended. Now, without reading the question, I can tell you that obviously, if Dembe contributes 32,000 net, his bands will be increased by 40,000. Now, many of the income that was previously getting taxed in higher rate band will now be get taxed at basic rate band. So what will be the tax savings that he will be able to achieve? 20% or 40%? More answers, please. Come on, guys, I need your participation. Yes, Azan, you're right, 20%. And the reason is that With the help of band increase, your income is now getting taxed at 20% rather than 40%. So you are still paying the tax at 20%. It is not that you do not have to pay the tax altogether. You are paying the tax but at a lower rate. So by paying the tax at a lower rate, you are able to save 20% of the amount as a tax. Okay. So sometimes students get confused that that there might be the tax saving at 40%. No, that is not the case. By increasing the band, many of the income that was previously getting taxed at higher will now be taxed at basic rate band. So the resultant savings are 30 to 20% of 40,000. Now, as far as the tax liability is concerned, I have told you that they will be able to save some tax. But as far as the NIC is concerned, I want to tell you one more important point. You tell me that by making the personal pension contribution, he'll be able to save the tax, but will he be able to save the NIC as well? Yes or no? Thank you, Shahzad Rahman. The answer is no, because you do not save any NIC by making personal pension contribution because they do not impact the NICs. They only impact your tax liability. So the NIC will remain same. However, he'll be able to save 40,000 times 20% of the tax. Now, the B part deals with calculate the, however, I still have to relate my answer to the scenario that I will when I'll read the scenario. So calculate the couple's overall saving for the tax year 2021 after taking account of additional legal fees of 2000. If the residential property is transferred to K and sold by him, rather than the property being sold by Dembe. Okay, so I guess this part relates to the CGT, and there's some residential property for which they're talking about. I have to read the question to see what is happening here. Then the third requirement, calculate the IHT payable, if any, were Dembe and Kato to both die in the near future, and explain whether or not it might be beneficial to leave assets worth of 325,000 to their children when first of them dies. Okay, for that I have to read the question, but what I know is that part C deals with IHT. So guys, you can see that it is a question which deals with all types of taxes: the inheritance tax, the corporation tax, the inheritance tax, the capital gains tax, and the income tax, all three taxes. However, you have clearly told about separately that which part relates to the which requirement. Remember, I told you about an article, higher skills expected from students between to bridge the gap between ATX and TX. So I told you that in advanced taxation exam, the topics normally gets tested or the questions normally gets tested on multiple taxes, and the examiner are trying to bridge the gap between TX and ATX by testing this type of questions. So you should expect, and this type of question can normally be tested as a 10-mark question, because rather 2 15-mark question will primarily be focusing on income tax and corporation taxes. Okay, however, I find that easy because there are small requirements, and if you know about the small requirements, it is easier to gain marks in small requirements rather than the longer ones. Now let's read the question and relate what our understanding with the scenario. You're a trainee chartered certified accountant dealing with the tax affairs of Dembe and husband Kato. I'm surprised that Dembe is a she. I mean, it's a female. Normally, the Dembe is the name of male. Dembe is self-employed, and her trading profit for the year ended 31st December 2020 is 130. Okay, so she's a high rate taxpayer. If she makes 40,000 gross into her personal pension contribution, most of his income that is previously getting taxed at a high rate will be now taxed at basic rate. She will not have any other income or outgoings for the tax year 2021. But standing at 130, I want to give you a hint. There is one more advantage that Dambe can claim by making 40,000 of the contribution. What is that apart from band extension? Come on, guys. Think. I'm glad that two of the students have answered it very correctly and good. Yes, guys. At standing at 130, Dembe is not getting any of the personal allowance because once you cross around 125,000, you don't get any of the personal allowance. However, the personal allowance is dependent upon your adjusted net income. And how do you calculate adjusted net income? You take your total income before any reliefs or exemptions and deduct two things out of that: personal pension contribution and gifted donation, and that too gross amounts. So her income was 130 before any reliefs, and if I deduct 40,000 out of the 130, her adjusted net income will be 90,000, which means her adjusted net income will be below 100,000, and she'll be getting the complete personal allowance. To tell you where this topic can be found in my notes, I'll take you to my notes. Here, if you visit the first chapter, that is income tax, there's a topic called personal allowance, and there you can find that if your ANI, which stands for adjusted net income, is up to 100,000, she will be entitled to 12,500 personal allowance of complete. However, if your income is above 125, you will not be able to get any personal allowance. So in our case, Dambe's net income needs to be calculated first to check whether she is eligible for any personal allowance or not. And the formula here is: take your income, that is your net income before any reliefs or allowances, then deduct from it the personal pension contribution and the gifted donation. But these amount needs to be grossed up before deducting from that amount. Whatever your amount is, that is your benchmark. If that amount is above 125, still above 125, you will not be able to get any personal allowance even after making contributions. But if after making contribution this amount falls below 125,000, you may be able to get any personal allowance. In Dembe's case, you tell me that how much personal allowance will Dembe be able to claim after making the contributions? Thank you, Shazad and Azan. You're right. Complete 12,500 because her adjusted net income will fall below the lowest threshold, that is 100,000. So there'll be two savings that she'll be able to make. One is the income that will now be taxed at 20% rather than 40%. So that 20% of that amount, and the 12,500 personal allowance. On 12,500 personal allowance, how much saving will she be making? 20% or 40%? That is a tricky question, isn't it? Guys, 20% or 40% savings? Yes, I am asking that by claiming the personal allowance or by having the personal allowance back, how much tax will she be able to save? 20% of 12,500 or 40% of 12,500? For all the students who have answered 20%, I would like to ask them that you tell me that by having the personal allowance back, does she have to pay the tax on 12,500, or will that amount be completely exempt? If you guys say that no, sir, it will be completely exempt, then I will ask you, wouldn't the saving be 40% because she's a high rate band payer? The difference between band extension and personal allowance getting coming back is that when your band gets extended, your income comes from 40% to 20% bracket. But when you have the personal allowance back, your income comes from 40% or whatever the band pair you are to 0% bracket because you do not have to pay any tax on personal allowance. So 12,500 income will be saved completely and there will be no tax payable on that. And as she's a high rate band payer, she'll save the tax at 40%. So do remember that whenever you get your personal allowance back, no matter how much you got back, the tax savings on that will always be at a high rate. However, on band extension, the savings will be at a fractional rate. Fractional rate means you were firstly paying on 40%, you now are paying 20%, so the resultant savings are 20%. Okay, guys? So do remember that there are two types of savings that Dembe will be able to make. One is that 40,000 of the income will be taxed at 20% rather than 40, and one is that she'll be saving 40% on 12,500. Now, let me open spreadsheet and start solving this question with you. So you should know as to how you should present it on the spreadsheet. Okay, I hope you can see the question. Now, guys, why I do this split screen again and again? Just to create an environment like the CBE practice platform, like the exam will be in our live exam, because I want to keep you focused in the CBE format. You have to come out the paper practice and start practicing on this format, split screen. Take a picture of the question from the kit, put it onto your computer, split the screen half and half, open the spreadsheet in the second window and try to solve the questions on spreadsheet. This will help you a lot. So guys, before I move on, I would like to ask how many of you do agree with my this approach that the practice should be on CBE before the exam? Thank you guys. Okay, so let's start. The question is Dembe and we're doing its part A. Now, we have to calculate the tax savings. Tax savings will first tell that what will be the gross contribution here to the examiner, and we'll tell examiner that how we have computed that. It is 32,000 times 100 over 80, and we'll tell examiner that it is 40,000. What is that? Gross contributions. Now, tax savings will be that 40,000, we'll see band extension and PA. PA stands for personal allowance. From band extension, 40,000 worth of income will now be taxed at 20,000 times 20%. It will be 8,000. If you want to apply formula, you can. 40 minus 20 times 20%. So 40,000 minus, sorry, it's 40,000 times 40% minus 20%. So this would have been the equation, and you could have applied the same here as well. However, as I know the direct answer, I'm not putting the formula here. The answer will be 8,000, but you can for your convenience. put the formula here. The 12,500 that I got back in the form of personal allowance, I told you that we'll be making savings of 40% on that. And I know the answer directly, but you can apply the formula. It is 5,000. Okay. So the total amount will be this plus this, that is 13,000 tax savings. You'll be able to save 13,000. So as far as the income tax part was concerned, we are done with that. And whenever you get tested a similar type of question, do remember that whenever you get personal allowance back, you get savings at a higher rate. However, whenever your band gets extended, you save at a differential rate. And you have to clearly mention here less NIC 0 to examiner, because you have to tell him that you know that there will be no impact on the NIC because of the personal pension contribution. Or you can write a line that the personal pension contribution does not impact NIC. It is your choice, whatever you want to write. Okay. But you have to mention that clearly because it was mentioned in the requirements that calculate the tax savings on income tax and NIC. So guys, before I move on to the IHT part and the CGT part, kindly raise your hands that you've understood. If you have any questions, put them in the question box. I'll try to answer in between. Okay, now for any of you can't see the question clearly, what they can do is they can download the handout if they think that the text is not clear via the screen share. Second is sale of residential property. During March 2021, Dembe is going to sell residential property and this will result in a chargeable gain of 67,000. So they told me the gain directly. I do not have to calculate the gain myself. Dembe wants to know whether it would be beneficial to transfer the property to Kato, her husband, as no gain, no loss transfer prior to it being sold during March 21. Okay, the transfer from Dembe to Kato will cost 2,000 in additional legal fees, and this cost will reduce the chargeable gain to 65,000 if the disposal is made by Kato. Now guys, before we read the question further, I want to ask you that between the spouses, if they transfer the asset to each other, will it give rise to any CGT? Exempt. Yes, you're right. It will be rather the better explanation is that it will transfer at cost. So the other spouse will be considered to acquire the asset at cost. Now, moving on, Dembe has already made other disposals during the tax year which have utilized their annual exempt amount. Kato, however, not yet made any disposals. So obviously, one saving will be that if she transfer it to Kato, when he will be selling the asset, he will first deduct his annual exemption, which is not available for Dembe. That will be the first saving. The second is that we can see from the first part that Dembe is a higher rate band taxpayer. But for Keto, his taxable income is mentioned here, which means some of his basic rate band is left. So there are two advantages that we can take. However, the disadvantage is that there'll be a tax saving, but they have to incur 2,000 as well to transfer the cost to each other. So what I'll do is I'll calculate that what will be the tax that Dembe will have to pay and compare it with the Kato's tax. So I'll be able to calculate the tax savings. Whatever my tax savings is, I will deduct the 2,000 from that because it is an expense that they both have to cater. So let's firstly assume that if the disposal would have been made by Dembe, then what would be the CGT? So I'll write B here. I'll write residential property disposal. Now, by Dembe. So if Dembe would have made it, the gain was 67,000. It would have been taxed at 20% or 28%, guys. What was the rate? 20% or 28%? Thank you. 28% it will be, as it is the residential property. If it would have been anything else, then the rate would have been 28%, 20% rather than 28. So for Dembe, I can quickly calculate that it's 67,000 times 0.28. The tax would have been 18760. The calculation was pretty straightforward, reason being we knew that there is no annual exemption amount available and she's a high rate band payer. So the calculation is simple for Dembe. However, for his husband Kato, we have to consider both things, the band as well and the annual exemption amount as well. So for him, the gain is 67,000 less the annual exemption amount, that is 12,300. Now, the taxable gain will be this amount plus this amount, 54,700. Okay, less, rather we'll apply the rates. Now to calculate the rates for CGT, we first have to check that what is the basic band left and what is the higher. For basic band, we have to check, and we can put the formula here, that the total basic rate band is 37,500. However, his taxable income was 21150. So this is the amount that income tax would have utilized. 16350 is the basic rate band that is left. So out of total gain, this minus, sorry, this is the total gain. Out of this, 16350 will be taxed at basic rate. So what is the gain that is left for higher rate? It is 38350. Okay, now we'll multiply this amount with 18% and we'll multiply this amount with 28%, 10738. Now we can calculate the total gain, total tax liability. In his case, it is 13681 as compared to 18760 that was in the case of Dembe. Now, tax savings will be this amount that was the tax liability of Dembe minus this amount that is the tax liability of Kato. 5079 they'll be able to save. Now, is there anything that I forgot? I told you that there is a one thing that I'll deduct and at the end. What is that? 2000. What 2000? The additional charges that would have been paid. The legal fee, exactly. So guys, regardless of that tax saving, they have to incur 2000. So I'll write legal fee, that is negative 2000. So the net saving they can make is this. Okay. However, there is one more point that you guys need to remember, that when you calculate the gains tax for spouses, or even not for spouses, there is a terminology called incidental cost of disposal. Incidental cost of disposal means any cost that you have to incur to sell the asset. For example, if I'm selling a house, I have to pay commission to the property agent. To them, I have to pay some commission. That commission will constitute as a part of the cost of the asset. So you have to add it in the cost, it will reduce your gain and thus save your tax liability. So what do you think that when Dembe transfers the asset to Cato, wouldn't her cost be increased by 2000 because 2000 is the incidental cost of disposal? So guys, will the cost increase or no? It will increase, guys. Why? Because between spouses, we assume that the asset is transferred at a cost. So the asset was basically worth 67. By transferring it to Cato, its cost has increased by 2000 because 2000 is the incidental cost of disposal. So for Cato, the cost would have been 67,000, 69,000 rather than 67,000. So what you can do is you can either increase the cost or you can reduce the gain by 2000. So what I can do is I can reduce the gain by 2000 because if you increase the cost, the gain reduced by the same amount. If I just click here, he will update all of my workings. That is the advantage of putting formulas everywhere, that if you make a mistake with a single click, you can easily calculate or correct your answer completely. Now, one student is asking about my basic rate band formula. There you can see that I have taken 37,500, that is the complete amount of basic rate band, and deducted to 1150, the amount that was mentioned in the question, that Cato's taxable income is this, which means this is the amount of basic rate band that has been utilized by the income tax. Guys, any question till here? Okay, so we'll move on to the last part that deals with inheritance tax. Dembe, who knows nothing about inheritance tax, is concerned about the amount of IHT which will be payable when she and Cato die. The couple's combined chargeable estate is valued at 880,000 for the purposes of IHT. Okay, the estate includes a main residence as well at 360,000. Under the terms of their wills, Dembe and Cato have initially left their entire estates to each other. Then, when the second of them dies, the total estate of 880 will left to the couple of children. The couple are not sure whether to change the terms of their wills so that the asset worth 325 are left to their children when the first one dies. Neither Dambe nor Cato have made any lifetime gifts. Guys, if they have not made any lifetime gifts, it means both of them have their complete nil rate band available. Now you tell me, we have tackled that in the last question as well. Whenever the spouses transfers or left their estate to each other, does it give rise to any IHT liability? No. Okay, that is exempt, which means that if any one of them dies, the other spouse does not have to pay any tax. Now, the second thing is, what do you think? If any of them dies because they have not made any gift, will the second partner inherit the other's nil rate band completely? What do you think, guys? Will the surviving spouse get the complete nil rate band? Yes. Now, as their estate includes a residence as well, what about the RNRB? Will the surviving spouse have the RNRB of him or herself as well as the spouse that died? Yes, Sally, thank you. Even RNRB will be transferred. So, guys, their total estate is valued as per the question is around 880. Let's say if one dies and the estate is transferred to the other one, obviously at that instance there will be no tax. Now, let's say the second died as well. So, out of 880 estate, their beneficiaries or their personal representatives can number one claim the basic rate band for both, that is 325,000 and 325,000 for both. Second, they can also claim 350,000, that is two RNRBs for both, which means their nil rate bands are even more than the estate that they currently have. So now you tell me, does it matter if they follow any sort of strategy? Whether they keep it, whether they transfer some of it to the children, whether they transfer some in between them, does it matter? No, it does not matter whether they follow any strategy. So how you'll be writing the answer? What you're gonna do is you will calculate the calculations that I have calculated with you and then write the for the examiner. So it is part C. So I'll start with part C. Total estate 880,000 less NRB 325K times 2 less RNRB, that is 175 times 2. That I know that it is 350 and that is 650. So you'll write 0 underneath chargeable estate because obviously the state cannot be negative. And underneath you write and tell your examiner that as they have not made any previous lifetime gifts, number one, so they'll have their full nil rate band available. Secondly, they have the main residence in their estate which they are also planning to leave to their direct descendants, therefore fulfilling the conditions of RNRB. So therefore they can inherit the RNRB left of the one that is surviving spouse, and in that way their total nil rate bands, be it RNRB or NRB, exceeds the amount of the estate. Therefore, no strategy will give them any benefit as they do not have to pay any tax. Rather, not they, their personal representative not have to pay any tax on the property. So guys, any questions still here? Okay guys, so we are done with today's questions. Today what we have done is we have solved two OTQs from the past paper, that was primarily focusing on IHT, then two questions that related to IHT as well, and then a single question that was related to multiple tax questions. I've also tried to teach you as to how you can use my handout or my notes. Apart from that, I've tried to explain you how you can read or approach the section C questions as well as section B questions. So now, as the topic is finished, if you want to ask any generic questions, I'll welcome those. If anyone has question related to any topic of the syllabus, they can ask. Okay guys, lastly I would like to, Shazad, it will be shared with you by ACCA shortly. So if I would like to take you to the practice platform again, there you can see that you have the September December 2020 exam paper available, two practice tests and one specimen exam. So four full-fledged papers in the CBE format. Do them. Then there's a article. If you go into the study resources, ACCA qualification, select the taxation exam, then you'll come to technical articles. So there is a good article called higher skills, but if you find that article difficult, don't be worried about, because this is basically for the 10 mark question that I've discussed with you. In that, very tough examples have been given. However, you are not expected to see that tough examples. So read that article. It is a good article. Then below that, you have many articles which are very beneficial for you, because examiner has tried to explain in a very precise matter all of the parts of the syllabus. Then on top of that, you have the Finance Act 2020 article, which I especially recommend to repeaters, because it tells you chapter wise changes. What are the changes in income tax? What are the changes in capital gains tax? Then the remaining part of the syllabus. So guys, as we are in the last 10 minutes, whatever you guys have any questions, please do ask in the question section and I'll answer one by one. Okay, Azan has asked a question that in order to claim R&RB, should our state be over 325? No, Azan, our state should be over 175. 325 is the amount of nil rate band. The R&RB amount is 175. So your residence should be more than 175. In your state, if there is a residence included, only then you can take the R&RB. If you just have an estate in which there is no residence, then you cannot claim R&RB. I hope I have answered your question. Recorded lectures will soon be shared by the ACCA. I guess day 1 and day 2 is now available on Vimeo. Yes, Azan, what actually matters is the value of private residence, and that too after deducting all of the relevant mortgages amount. Even if your property is more than 175, but after deducting the mortgage amount, it falls below 175,000, you will not get the complete 175,000. Any other question? Joel, if you click on, let me take you to Vimeo. You just have to click on Google Practice to Pass ACCA. If you click on that, click on the first link, and then on the right side you'll have this link, Practice to Pass Recorded Lectures and Tutor Handouts. Click on that. A PDF file will be downloaded. Open that PDF file. Click on any of the link and it will take you to ACCA's Vimeo channel. Now you're in ACCA Pakistan Vimeo channel. Then click on the channel. And here you have the video. You can see that there you can see my video as well. It is for the advanced taxation exam because I'm conducting the webinar for the advanced taxation as well. And this is for the taxation exam. So there you can find. So all of the students who are constantly asking me about the recording or where they can find the recording, I hope I have answered your question. Any more questions, guys? Okay, guys, with that, we'll sum up our today's session. I hope to see you tomorrow with some more questions, and tomorrow's topic is value added tax. So see you tomorrow, guys. Till then, take care. Bye.